Good afternoon, everyone, and welcome to IMAP's series, where we're dealing with zero rates and what they mean for managed accounts. This is a series of 3 webinars, and we're going to have them on this Monday today, Wednesday and Friday. It's IMAP's plan to do more of these 3 series webinars so that we can deal with some of these topics in more depth. So at the end of this webinar, you're going to get a link asking for feedback, and we'd like to know some of the topics you'd like to hear about. And also, we'd also like to know what you think of the 3 series webinars. So today we're dealing with a topic that's certainly front and centre. You can't turn on the television without hearing about interest rates at the moment. And we're talking about zero interest rates and how we can work within these parameters. So session 1, we're dealing with how the traditional goals can still be met for the defensive portion of the portfolio. I'm not going to give away too much about session 1 yet, because the 3 speakers today will certainly have more to say about this than I do. Today we've got Michael Karagianis from JANA, who is also going to be moderating the Wednesday and Friday session. We've got Al Clark from MLC Investments and Chamath de Silva from BetaShares. On Wednesday, we'll be taking a deep dive into fixed interest, the fixed interest asset category. And in that case, we've got Jesse Imer from Mason Stevens and Michael Frierson from Real Asset Management. And they'll be looking at where the best opportunities lie within fixed interest and explaining some of the features of the fixed interest category. And then on Friday, we'll be looking at alternative ways to access the traditional attributes that people go to the fixed interest category for, be it downside risk protection, income, or diversification. So today's webinar, we've got about 45 to 50 minutes. You can ask questions during the webinar. On the slide there, you'll see the Q&A button. So those questions are visible to the participants in the webinar, the speakers today. The other people listening in today can't see your questions, and I encourage you to ask questions, because if you're wondering about it, probably some of the other listeners are as well, so don't be shy. So without further ado, I'm delighted. Oh, by the way, one further thing, you can find all the slides and the copy of today's webinar on our website. And so we're sending out a link, and there's a few extra slides in the appendix. And some of the slides are quite data rich, so you might want to refer to those later if you want to seek clarification on some of those points. So without further ado, I'm delighted to hand over to Michael. Over to you, Michael.
Thank you very much, Amanda. And welcome to everyone to what is the first of what will be, I think, a very interesting series on building defensive portfolios in a zero interest rate environment. By way of introduction, I'm Senior Consultant and Head of Retail Partnerships at JANA Investment Advisors. Joining me today is Al Clark, Head of Investments at MLC Asset Management. He's been there since November last year. Previously, Global Head of Multi-Asset with Nico. Head of Multi-Asset Asia Pac with Schroders Investment Management. So a wealth of experience in terms of dealing with some of the issues of not just looking at fixed income in isolation, but the role and purpose of a defensive component to a broader asset class. Joining us is Sham de Silva from BetaShares. And Sham, prior to joining BetaShares, was with the Reserve Bank, so impeccable pedigree there, Sham. Working as a fixed income trader, and he was based in Sydney and London, and he's going to share the BetaShares perspective. But really the objective today is, I guess, to set a helicopter view, which we can then follow up on Wednesday when we have more of a deep dive into fixed income, and then on Friday when we look at other ways to building a defensive portfolio outside of fixed income. But let's start firstly, I guess, and ask both parties, Al perhaps going first, to really just give us 2 to 3 minutes of introduction as to their take on the role of defensive portfolios within an asset allocation perspective.
Excuse me. Thanks, Michael, and welcome everyone. So as Michael mentioned, I've been involved in running these types of asset allocation product for a while. So it's closing in on 30 years now. And over that time, so mainly diversified portfolios. And over that time, we've had the benefit of being able to lean on our bond component to fulfill a number of roles. It delivered us income, it was usually quite liquid, and it was also generally negatively correlated to our growth part of our diversified portfolio. So bonds, we could use them to fulfill a number of different defensive or protective sort of mechanisms within our funds. Those days, unfortunately, are long behind us. So the last 10 years, we've all been grappling with this issue that Michael raised. What do we do in a zero rate world? How do we get defensive allocation into our portfolios? Unfortunately, through central bank policy and also the environment, rates are at incredibly low levels across the world. Any fixed income is not really delivering us much in the way of income. It's questionable whether it's going to be negatively correlated to equities, and depending on the type of fixed income, which Cham will probably allude to, will determine whether it's liquid or not. So some of those things that we had for so many years, we just don't have anymore. So that's the conundrum we're facing. What do we now do as diversified portfolio investors to try and embed, some sort of defensiveness and be able to fulfill those roles in our portfolio? So over the course of this webinar, we would sort of want to talk through, from an MLC perspective, how we address some of these issues. Part of it really for us is about being flexible. Now that we know fixed income is not going to deliver to us what it used to, how do we look for other mechanisms, other exposures to try and fulfill some of those roles? And the other thing is just to be innovative. Think outside the box. It's not just about leaning on the things we used to in the past. It's now going to be about finding completely different ways of fulfilling some of those objectives. And that's just the reality we're facing into. I mean, it's not by chance this has happened. This has been by design. Central banks have been quite pointed in their desire to keep rates low and make sure that savers have been penalised as a result of this. So as the savers, we now need to react. And that's, I think, what we're trying to sort of get to.
Al, thank you very much for that opening comment, and I think it's raised a few issues that we will touch on in the Q&A session. But Cham, perhaps over to you to give us a few thoughts up front, and then we can perhaps devolve into some questions.
Yeah. Again, I think Al's completely correct. I'd echo the same sentiments. Ultimately, we probably need to have a more fine-tuned solution with how we approach I guess, our defensive assets. I think it's more important than ever not to view growth and defensive in such a siloed way as we've viewed them in the past. And ultimately, defensive assets and fixed income should be more of a bespoke solution rather than a one-size-fits-all. So I think what we try and do at BetaShares is really understand, how asset classes interact with each other. And I think once we've got a better handle on that, we'll see, which types of fixed income can provide our portfolios with the defensiveness they need to help us achieve our investment objectives. And one thing I'd like to echo is that fixed income and fixed income risk factors are pervasive, and they can even intrude into our equity exposure. So understanding how our equity exposures also interact with, say, the rate environment is also important for portfolio construction going forward.
No, thank you very much for that. Al, you mentioned, I think, Cham, you really reinforced the point that classically fixed income has solved a number of purposes simultaneously. So the pursuit of income, the pursuit of diversification, and I guess the provision of liquidity in a broader portfolio context. Al, you pointed out that in the current environment, many of those, if not all of those aspects, could be breaking down for fixed income investors. Can we put that in the context, I guess, Cham, of what's happened over the course of the last little while, where, if we date back to the GFC, of course, portfolio volatility exceeded expectations. People were surprised by the amount of volatility that was generated by defensive portfolios going back as far as that time. But that certainly occurred again in the aftermath of the COVID sell-off, where again we saw portfolios perhaps not displaying the same sort of resilience that we might have historically expected, and emanating to a large extent from that defensive portfolio perhaps behaving not quite as how people might have expected. Do you want to just comment on your thoughts about that, and what are the flaws in the system here? Is there something more fundamental that we need to be mindful of?
Yeah, so I think during both the GFC and the COVID crisis in March this year, I think a lot of investors underestimated the degree of credit risk and the liquidity risk that they were taking on within their defensive exposures. Now, it had become, pretty common to chase yield within defensive allocations, and you were seeing credit becoming a larger part of, the typical fixed income portfolio. And I think both the GFC and the COVID crisis, they were really both credit shocks and liquidity shocks at heart. And what you saw was not only a blowout in credit spreads, but this credit spreads blew out across all the tiers, all the various levels of credit quality as liquidity risk was elevated. And I think that's something we have to keep in mind, is that during these periodic liquidity crises, these credit crises, the downside risk with credit can be asymmetric. And that's something to keep in mind if we are using fixed income primarily as an equity diversifier.
Al, do you want to add a few thoughts in that regard, in terms of the impact of credit on portfolios and greater use of credit and perhaps extending into other asset classes?
Yeah, so Cham's right. When you're trying to get yield, you've got to go out the risk curve. That's just the reality we face into, isn't it? The spreads are incredibly tight. Yields themselves are incredibly low. So if you're trying to generate any sort of income, you've been forced. So if you used to be in, AA credit, well, now you're at best, it's triple B spreads are 100 basis points now, so they call it even less, I think. So your yield is still quite low. You might even be forced into high yield. So maybe you're sort of going into a part of the risk curve you're just not used to dealing with. I think that is the reality we're facing into. And we've seen that play out exactly as Cham just alluded to, in environments where liquidity has started or the market started to turn. People have got to be mindful of the investments they're in, maybe not quite being as liquid as they'd hope. It's worth thinking equities are actually very liquid. So a large part of our portfolio can be quite liquid. The problem is that at the point in time when we generally want liquidity is the point in time when equities are doing their worst. And that's the hard bit. As a portfolio manager, you really don't want to be selling equities in the first quarter of 2020. They're liquid and you can sell them. It's just that you don't want to be selling at that price. So it's trying to find that balance within your portfolio. I think we'll get through this as we talk through today, but one of the messages we want to get across is just that capacity to diversify your liquidity across a number of different drivers. I mean, it was really surprising in the first quarter to see treasuries do really poorly liquidity-wise as well. There was actually a few days where while equities were selling off, treasuries were selling off as well. That was purely a liquidity event. So even what you'd think would be the most liquid instrument in the world still had a really poor liquidity. It was only a few days. I don't extrapolate that into the future, but it was just interesting to see that liquidity can disappear sometimes when you most need it. So one of the things we'd really advocate as portfolio managers is trying to make sure you distribute the liquidity and don't just lean on one engine to provide liquidity in that environment.
Is what you're alluding to, Al, potentially a function that as fixed income markets or even traditional fixed income markets drift towards zero, and in many cases around the world now we see negative yields, we're actually seeing them behave in a atypical manner, that the rules of nature effectively are being distorted by that phenomena. And as a consequence of that, even conventional fixed income, government debt, we may not be able to rely on it to provide the same sort of risk aversion as we've seen in the past.
No, I think that's exactly right, Michael. I think there's a slide. So I don't know if there's a slide that we could maybe refer to, which is showing that in the episodes. So we looked at MLC. I just had a quick look at some of the past drawdowns, so equity drawdowns. So the one before that. It's the other way. Sorry, whoever's controlling the slide. So it's the one before that one. And so you can just see in that little table. So just looking at the last 20% equity drawdowns. So 2008 is the most obvious. Q4 2008. Equity drawdown was 22% just in that quarter. The whole drawdown lasted much longer than that quarter and was much longer, but just those 3 months. So Australian equities lost 22% in those 3 months. And our bond yield, so our 10-year bond yield, fell from 5.4% to 4%. So that's the duration. I don't want to get too much into the convexity here, but the duration of that was probably in the order of 7 to 8 years. So you end up with an 11% gain. So you can see 140 basis point fall in bond yields, sort of offsetting almost half of the equity loss. So then fast forward to Q1 this year. So we had a 24% loss. So it was actually a really extreme quarter, as everyone probably remembers. 24% loss in Aussie equities. Yields were already at 1.4%. They fell to 70 basis points or 68 basis points in the Australian 10-year. Now, the duration's higher. That's that convexity that you probably will talk about later on when you're doing these chats in a couple of days. But so the convexity of bonds helped, but there's nowhere near enough to help offset that loss. So now you're only getting a third or even less. It's sort of close, between 25 and 30% of your loss in equities being protected by bonds. As you just alluded to, Michael, that asymmetry is now not working in your favor. If you want to get anywhere near the same level of protection from government bonds going forward, you'll need Australian bond yields to go significantly negative. So it's interesting to see in those two episodes how it was the move offset half, offset 25 to 30%. Going forward, if we're going to offset anywhere near that, then we need 10-year government bonds in Australia to go into negative territory. So it just highlights, exactly as you were just saying, there is a difficulty in particularly government bonds being able to protect in any way what they used to be able to in the past.
Jam, your thoughts on that? Obviously, this is an absolutely fundamental question. Bonds have been such a linchpin for defensive portfolios for such a long period of time. Is it a broken story? What can we look at in this space that perhaps provides an additional source of protection? Should we be scared of negative interest rates? I mean, is it just an illusionary barrier? Once we go through it, we're just at the other side. What are your thoughts on this?
Yeah, look, I think at a high level, Al's completely correct. Government bonds can't provide the same nominal yield or say nominal return buffer as they did in the past. Simply the mathematics won't allow it unless we go deeply negative. However, there is the option, obviously, to take on more duration because the longer end of the curve can still have material yield declines. However, again, that is incorporating additional risk factors to your portfolio that you have to be mindful of. Regarding your question about negative rates, negative yields, I mean, we are seeing, more central banks around the world, either move towards negative rates or, at least signal to the market that they are, considering it. Both, the Bank of England, has clearly signaled that they will likely move negative next year. The RBNZ did signal they're going to move negative, although they have backtracked a little bit from that, but they've left that option on the table. So even if it isn't our base case, we should still, be aware that it is a possibility, particularly if, inflation continues to shoot on the downside. And, if we did have actual deflationary expectations take hold, then, that is the greatest fear of central banks right now. So again, it depends on how the macro environment evolves. I guess regarding, how to protect your portfolio, that, 10-year government bonds won't provide the same protection as before. So the option is, do you go into 30-year government bonds and knowing that, they did behave quite erratically during March, that's also something to consider. So, maybe the solution is maybe reassessing your overall portfolio and making tweaks either to your equity allocation, and that might be the defensive tweak that your portfolio needs, given how close we are to zero yields across the curve.
Well, we'll talk about some of the alternatives, I guess, to look forward to defensive portfolio construction. We did get a question come through, actually, asking what the probability each of you thought might be for negative interest rates in Australia moving forward. Cham, you mentioned that it's not your base case, but what probability would you put on it?
Well, right now, I mean, we have December bank bill futures trading at an implied interest rate of 1 basis point. We've got BBSW that was set at 2 basis points. Has been set at 2 basis points for the past couple of weeks. The bank bill options market is, it's pricing in a meaningful probability of negative rates. So we could easily see negative interbank rates, given the RBA was quite sanguine about that. They said, we wouldn't be surprised if interbank rates turn negative. Now, whether they'll take the cash rate target negative, that's a completely different question. Historically, with other bond markets, we have typically seen front-end yields tend to lead monetary policy. So, such as, in Europe, the German 2-year yield went negative really before the ECB signaled it. And we've seen similar things, with the UK curve as well. So I think, it's probably worth keeping an eye on the Australian front end, because the bond market and the interbank futures market would probably signal it before the RBA makes it explicit.
Al, I know you have a scenario-based approach to the way you go about investing, but what would you put on the probability of an outright deflationary pulse that sends interest rates negative at this point?
Yeah, you've loaded the question by putting the outright deflationary pulse in front. So if we get an outright deflationary pulse, my probability goes up significantly, Michael. So you're right. It's a really interesting question to think about. The probability is not zero. So I don't know what it is. If it's a company, if we do have an outright deflationary pulse, which I think the probability of that has gone down given how governments are behaving. But if we do have that, then you're right, the probability does go up. Why do you cut rates? You cut rates for a credit response. You alleviate borrowing costs, yes, but you cut rates to try and generate a credit response as well. One of the issues that they've found in Europe, well, Japan's a classic example, but Europe was first to try this. They weren't really able to generate much of a credit response. So it has alleviated borrowing costs. There are issues associated with that. You end up with zombie companies and those sorts of things. So that may hamper growth going forward, and we'll find out in 10 or 15 years probably. But the other bit is it's negative rates have yet to demonstrate their capacity to generate a credit response. And while that's still the case, I think most central banks from here will be reluctant to pull that lever. They'll like to talk about it, as Cham just said. BOE's been talking about it, RBNZ's been talking about it. RBA's equivocally said they won't, but that may change, particularly if you get that deflationary pulse that you mentioned, Michael. But I think they like talking about to suggest that they still have that arrow in the quiver. It's still there. It's something they can do. It's still a lever they can potentially pull. But I'd be surprised if those that haven't done it yet do it in the near future or in the medium term, to be honest, unless there is a significant deflationary risk.
So it sounds like the consensus is very much along the lines that fixed income is changing its stripes. The role that it's previously provided in terms of being able to tick all the boxes from a defensive point of view have really broken down. And the question is whether it can tick any of those boxes, I guess, but it seems unlikely that it's going to, of itself, tick all of them. People have taken on more credit risk in the process. And that does beg the question, I guess, whether using the term defensive portfolio is really an accurate description of what people are loading into that part of a diversified portfolio these days. It may not be as defensive as we previously have seen, or we think it could be in certain market environments. It may be the very antithesis of that. It also, however, does beg the question, what else can we do in the defensive bucket to replicate some of the themes that we previously relied on fixed interest to provide? And that, I think, is the next stage of this webinar, where we really look at, what is possible, what we can do in the current environment, looking beyond the boundaries of fixed income to try and construct defensive portfolios that maybe, provide us with that, that additional defensiveness, provide liquidity, and maybe even provide a bit of liquidity to the portfolio. But Cham, perhaps to throw to you first, how would you go about constructing a defensive portfolio in the current environment, contrasting it with what we talk about as the historical norm?
Yeah, so I think historically, traditional fixed income, even high-grade government bonds, did have the ability to provide income, capital stability, and equity diversification. Given in the past, real yields had been quite positive. Now I think the trade-off is more pronounced. You really have to make that decision. Do you prioritize income, or do you prioritize, say, liquidity or diversification? I think one thing about, say, the March drawdown, even though government bonds did behave somewhat erratically during that third week of March, they still did allow you to buy more equities on the dip than corporate bonds, inflation-linked government bonds, or private debt, just because they still did provide that baseline of liquidity that did disappear completely throughout other parts of the credit market. But coming back to your question about how do you construct a fixed income portfolio, again, it comes back, it should be a tailored solution. I don't believe that choosing, say, the broad benchmarks are the way to go. They are generally, there's big flaws with their construction, liability weighting being the main one, because issuers can just set their own weight. And right now, the federal government is basically driving most of the issuance within the broader investment grade universe. So that's something you have to be mindful of, that we are seeing an extending out of the duration profile of that index, and also an erosion of the yield of that index. So you might be able to maintain, your liquidity, but you're not achieving your income goals by, say, allocating to the broad index. So it comes down to, assessing what's in your current portfolio, how much equities are you holding, and what type of equities are you holding? How do those equity exposures interact with fixed income? How do they interact with duration risk? How do they interact with credit risk? And then take it from there.
Al, your thoughts on this point? I know you look at it from a particular perspective as well. Share your thoughts, please.
Yeah, this is the essence of what we're talking about, isn't it? It's hard. So I think you're right. Sham sort of outlined some of the pitfalls you're facing into in fixed income. In diversified portfolios, we've got a number of different assets to play with. The question we ask ourselves is, what were bonds doing? So what is it we actually need to replicate? Because we don't feel confident bonds can do some of those things. So what are the bits we need to try and replicate? So if it is protecting ourselves if real rates fall, if that's the component we need to do, well, let's find something that we think is more appropriately priced, or at least is not maybe quite as asymmetric in the way its profile looks, that can potentially fulfill that role. So in the duration-like assets, we'll look at gold. So we've had gold in the portfolios for quite a while now. It's not cheap, and it's an enigma. Gold sometimes does things when you least expect it. But it can be one of those things you can lean on when real rates are falling, and it's got quite a high correlation to falling real rates. Inflation-linked bonds, obviously another one, but again, not cheap. So for us, it's really trying to find, okay, there's some of the things that bonds give us. What else do bonds give us? Well, they give us some protection. So what else can we protect with? So we're looking at defensive strategies. So use derivatives in equities, look at currency. So for us, diversifying away from the Australian dollar. US dollar is a risk-off currency. What do I mean by that? When global equities fall, US dollar tends to do well. As part of that's a flight back into US dollar, because a lot of people have their US dollar liabilities. There's all these mechanisms that drive that. The US dollar is a risk-off currency. Yen is the same. Yen is a net creditor to the world. As things fall, then people need to get the yen back into their own country or into their own currency. So that behaves as a risk-off currency. So looking for those as mechanisms to help us protect the portfolios. And then there's a few others there, and we can talk through those if we have time. But the reality of what I'm trying to sort of project here is, for us, there just is not one solution to this really difficult question. It's a really difficult question. For us, it's about, let's think about exactly what we need to achieve. What is it in the portfolio we need that thing to deliver, and find the most appropriately priced exposure for that. It means being broadly diversified with those, but also being willing to be innovative. And that's, for us, for our team, that's the key. We've looked in some really weird places, if I'm honest, to try and solve this problem. And some of the things are working quite well. We're happy with the way they're going, but I think it'll be ongoing. We'll need to keep looking for ways of being able to fulfill these objectives in our portfolios.
I guess the further afield we look, the greater the complexity potentially, particularly packaging it up into a portfolio structure that an advisor can utilize, can recommend to a client. You've got issues in terms of fees, you've got issues in terms of liquidity potentially, you've got complexity that has to be explained to clients, you've got managed account structures that have particular requirements as well. How do you both approach that? I mean, you're both familiar with the managed account space, clearly. How would you recommend advisors introduce that within a managed account structure, or on an advised basis to a client, to really try and tick some of these boxes? Cham, do you want to go first on that one?
Yeah, I think it's important to have your desired asset allocation in mind, have your preferred implementation vehicles, and they all, whether it's ETFs or managed funds, they work within the managed account environment. So I think the managed account environment can facilitate that, and it allows you the asset allocator to make changes very quickly, whether they be strategic or tactical.
Fair enough. While we've been talking, we've had quite a few questions come through. So in the interest of time, I'll throw to one of you to answer the question. If the other one has a quick response to it, by all means. We'll get through most of these questions in the time allotted. Just looking at the amount of debt issuance that's going on at the present time. I mean, it is a global phenomenon. We're seeing it in Australia. We're seeing it everywhere. Is there a risk of crowding out here, that governments have really put effectively the foot to the floor in terms of fiscal policy. States are doing it in Australia and elsewhere. What does that mean for the corporate sector? Is there a danger that you actually end up with I guess, a default credit crunch by virtue of the fact that the government sector is borrowing so much money at the present time? Cham, you want to go first?
Yeah, I might just start. Look, I think a lot of that depends on the Reserve Bank's QE program, because they will absorb a lot of the federal and state government issuance. Now, they've indicated that they're looking to purchase around $100 billion until the end of financial year, but they could keep that running longer. I think what we have noticed though here is that there hasn't been a whole lot of Aussie dollar corporate issuance, particularly compared to what you're seeing in the US. And I think right now it's not so much that the government issuance is necessarily crowding out corporate issuance. It's just sometimes the hedging costs aren't working in the favour of foreign corporates, which are a big part of the Aussie dollar corporate market. So, I think as we see some of these hedging differences normalise, we could see corporate issuance pick up, because ultimately there is still an appetite for spread products. There is still an appetite for yield right now.
Al, do you have a quick response on that?
Yeah, I think Chan's right. The Australian corporate market hasn't had a history of raising a lot of money, so it's probably not going to get crowded out. In Australia, as you saw in Q1, we do it through equities. So Australian companies more than happy to capital raise. So while the US was issuing billions and corporates were issuing billions and billions of dollars overseas, US and Europe, to be honest, Australia was doing it all through cap raising. So that's been our history of how we raise capital in Australia. Over in the US in particular, Cham's right. The central bank they'll be the major swing factor here. As long as they're continuing to backstop this, and they've all rumblings to date suggest they will, then it's hard to see there being much crowding out going on, because you've still got an enormous buyer of debt that's going to swamp any other factor that we've seen before in history, basically.
Okay, next question. Quick one for you, Al. I'll throw to on this one. If inflation is at very low levels, potentially negative, why not simply put money into cash? Is cash perhaps underrated, albeit that it is at a very low level, but is it in terms of yield, is it underrated as a defensive asset class?
If we get deflation, then no, it's the right asset class. Look at cash holdings in Japan. So yeah, if the big part, it's a really interesting question, and it's what we grapple with every day. And the interesting part of it is if we get deflation. Now, we don't know. It feels like the balance. So as you said earlier, Michael, we use scenarios. So we do probability analysis across a range of what we believe are credible scenarios for the future. The deflationary scenarios have decreased in probability. The inflationary ones have increased. And for one specific reason, and that's the behaviours of governments have changed since the last crisis. So where in 2008, the governments were dragged kicking and screaming to add anything from a fiscal policy perspective. It was after the first initial bout, it was really hard to get governments to spend money, because they were really, really scared that they'd devalue their currencies and then it'd lead to inflation. Well, that didn't transpire for 10 years. This time around, governments couldn't get there quick enough. Central banks couldn't open the doors quick enough to do any sort of program you wanted to do. It was beyond anything we'd seen in history. And then governments followed suit. It was very easy to get that first $2 trillion over the line in the US, very easy to get the money over the line here in Australia. Now, while you're going through a change in election in the US, that's obviously ground to a halt, but I'm pretty convinced the Democratic government will be pretty keen to open the spigots again when they get the opportunity. So government behaviours have changed this time around. And part of that's to do with what Cham was mentioning earlier, where the central banks have, to a degree, been shown willingness to stand behind this deficit spending. Now, whatever that's the case, inflation becomes a higher probability than deflation. If they change, and it could happen, I mean, governments change their minds really quickly. If governments change their minds really quickly and central banks don't stand behind this deficit spending, then that changes. And that's what happened in Japan, obviously, for years. That's why the deflationary pulse just kept going through Japan. They couldn't coordinate fiscal and monetary policy to any great degree. If that happens here, that's a risk. But at the moment, the way they're behaving has our inflationary probabilities increasing in weight. I'm not suggesting inflation's a slam dunk, but the behaviours are pointing more towards inflation than deflation.
Well, let's pick up on that. You think the there's a greater probability of inflation at the end of this process. So you're not a believer in the Japanese deflationary trap at this point in time. So within your portfolios, I imagine then you would be starting to hedge against inflationary risk.
Yeah, so you're right. I don't want to suggest that we discount deflation because it's always a risk. And it is, as I said, it's just the probabilities of decrease. It is always a risk. But the really beneficial thing that's going on right now is it's cheap to hedge against inflation. Inflation-linked bonds are expensive, gold's expensive, but cyclical equities are really cheap. You want to go and buy financials, you can get them really cheap. You want to buy energy stocks, you can get them really cheap. So if you want to find ways of hedging against expected inflation, it's quite cheap at the moment. So that to us is a really nice trade-off. The probabilities in our scenarios have increased for inflation, but there's a really nice cheap way of hedging against it. So that's something that's permeating our portfolios as a theme right now.
Cham, just a quick response on that. I guess inflationary versus deflationary balance in probabilities. What's your leaning at this point?
Well, I still lead towards more of the deflationary camp, but I agree that the probability have increased towards some inflation pressures, just given how responsive governments and central banks have been. Now, the question is all this fiscal stimulus simply filling a hole that was created? So how much of it is reactionary versus how much of it is proactive actual stimulus? So that remains to be seen. I will just expand upon what Al was saying about cyclicals, and I think it's a great point that it comes down to the overall portfolio. You can get fantastic inflation protected exposures from growth assets. You don't have to get your inflation protection out of bonds or traditional defensives, because linkers, they are quite expensive. Floating rate credit is quite expensive right now. So if you do want some inflation protection, perhaps it's better to tilt towards value, tilting towards cyclicals within your equities, or maybe even commodity type exposures within your growth allocation. Because ultimately it's only really cash, and high grade bonds that provide deflation protection.
Yeah. There's a couple of questions that have come through, I guess, about, if you have fixed income in your portfolios moving forward, what is going to be the best way of accessing it? I guess there's a few issues here. One, I guess, credit risk, cost of management. We've seen a collapse in interest rates. We haven't seen a collapse in fund manager ICRs at this point in time to manage that sector. You've also got, the impact of issuer dominance in indices, which often have a big impact on passive approaches. Do you want to have maximum exposure to the largest issuers of debt out there? Is that a potential concern? Just ask each of you for a perspective on, if you were going to address fixed income from a implementation perspective, how would you go about it, particularly from a managed account perspective? Would you be looking, for example, at a more direct approach in this environment? Would you look at an ETF-based approach where clearly, you have a significant advantage in terms of lower cost structure? Or would it be more of an active managed fund type approach where the manager has a lot of levers, a lot of diversification opportunities? Perhaps Al, do you want to lead off on that one?
Yeah, sure. I think Sham will probably have more insightful comments than me on fixed income, but just from a really basic perspective, for us, fixed income is it's not about picking winners. Stocks are picking winners. That's essentially what stocks are. Fixed income is avoiding losers, because all you ever get back is your coupon plus your $100. At the moment, the coupon is really, really, really small. So you want to be really, really sure you get your $100 back, because there's not much comfort being given to take that risk. So for fixed income for us, it's very much about being as broadly diversified as possible, just because that avoiding losers is even more tenuous than it's been in the past, because you're not getting paid very much to take that risk. So I would totally advocate if you're going to go down direct routes, make sure that you're highly diversified. That's the only thing that I would really stand behind. Whether you choose a manager to do it or you do it in ETF structure, I mean, Sham might have some good views on that. I don't tend to mind too much, as long as we're comfortable that the level of diversification we're getting and what we're getting paid, so the actual risk premium we're receiving to take that risk, are lined up appropriately.
Cham, you want to respond?
Yeah, so I think once you've got your desired asset class exposures in mind, I think, if you can achieve it or implement it at the lowest cost, I think that's important. In a low yield, low expected return environment, one of the easiest things you can do is just cut fees, because you can't control returns. You can control risk and volatility to some extent, but you can definitely control fees. And I think right now, according to Morningstar, I think the median active manager is charging around 63 basis points. I mean, that's a very large part of the forward-looking returns out of investment grade fixed income. And that's probably more than an entire credit notch. So that's something to keep in mind. If you can get your desired exposure at a lower cost, you should do that.
Fair enough. Any other issues that you wanted to bring to the table? I guess, Al, your thoughts, just in summary as to where you stand on this point and what you're doing about it in your portfolios.
Yeah, it's the biggest question at the moment. I mean, the biggest question is inflation, deflation. That obviously is very closely linked to how much duration you want to hold in your portfolio. But as I said earlier, we've really been strong on looking to be innovative in this space. So our portfolios, we fortunately, because of the way we manage money, we have the flexibility to do some quite innovative things. So we can go and buy a basket of Australian miners, put some optionality around it, and essentially get a mining bond per se with about 8 to 10% coupon. Now, that's not a coupon because it's not fixed, it's a dividend, but it still looks significantly more attractive than other things we can get elsewhere. So having that level of flexibility and innovation, now that's difficult in an SMA or separately managed account world, I understand that, but there are things out there. You can use a gold ETF, you can use a VIX ETF, you can use, there's inflation-linked bond ETFs. I would advocate being really flexible and innovative about the way you want to approach this solution. We don't want a product push here, I know that, Michael, but we do. So Inflation Plus is an MLC vehicle where we do embed all the things we're talking about today. So if people are interested, we use that within our own accumulation portfolios as a liquid, fairly priced, we believe, way of getting protection and real rate exposure into a portfolio. So I'd recommend to people, look broadly for ways of solving this. There are some things that are off the shelf, and you can build some of these objective-based solutions, as I was saying earlier, ways of solving the problem specifically. You can build those yourself. So I'd look to do that.
Cham, your thoughts?
Yeah, I think at a high level, right now, advisors, asset allocators are very much spoiled for choice when it comes to ETF implementation vehicles. So it doesn't matter what your view is, what exposure you want, there is most likely an ETF out there that provides it, whether it's broad asset class, whether it's regions, whether it's sectors, whether it's even style factors. There's an ETF out there for you. So I think it comes down to the fact that you're not limited to any one asset class to implement a view. If you're worried about inflation, you're not limited to inflation-linked bonds. You're not limited to fixed income. You can take a tilt within equities. You can take on commodities exposures. Likewise, if you're worried about, say, the global growth, if you're worried about global growth, you don't have to take that tilt within equities. You can just go long duration. You can go into fixed income. Again, you're not limited. There are so many options, and maybe there are too many options, and it is overwhelming. But I think it's good to have more choice right now.
No, thank you both for that. Certainly from JANA's perspective, Al, you mentioned that this is a very topical issue. I think, Cham, you echoed that. I mean, it's probably one of the top tier questions that we are getting asked from a consulting perspective. How do you build a defensive portfolio in this environment? What do you expect from a defensive portfolio? Does it affect the overall portfolio construct? This is a theme that we'll pick up as we go through the course of the week. But by virtue of the fact that you may not get the same out of your defensive sleeve of your portfolio, does that have implications for the way you build the growth portfolio as well? And I think you're both right. You need to look further afield now. The idea of building a defensive portfolio based around purely fixed income, I think, is a really problematic position to have. It worked in the past, but it has increasingly broken down, and people have been surprised by how much it has broken down in certain market environments. I suspect that's not accident. I mean, it is a feature of the changing stripes of some of those component parts of a defensive portfolio, but it's just the structure and environment that we're in now. We need to think differently. We need to build portfolios a little differently. We now probably need a lot more help in terms of the building of those portfolios, both in terms of expert input, but also in terms of access to some of these building blocks. The fortunate thing is, as Al mentioned, you can get them off the shelf in terms of providing a one-stop shop for diversity. As Cham mentioned, you can actually look at the underlying constituents and look for ETFs or managed funds potentially that can fill in certain gaps. So you're trying to solve for some of these individual components, such as income, such as liquidity, such as diversification. Finding one investment that's going to do the whole lot, that is the magic pudding. And I think all of us would probably conclude that's a pretty tough ask in this current environment. So with that, let me call this to a close and throw back to Amanda to say some final words. Thank you.
Thanks, Michael. Goodness, that was a lot of material covered in 45 minutes. And there's so many sort of aspects that were brought up and touched on. Hopefully we'll get a chance to delve deeper into quite a few of those things in Wednesday and Friday in the webinars then, and maybe sort of cover off some of those questions in greater depth. We, as I mentioned before, will be putting the slides up, and there's a few more that you didn't see during the presentation on our website, and you'll receive a link to that. You'll also be receiving the feedback link, and I really encourage you to make suggestions about other subjects that you'd like to take a deep dive down. Thank you very much as well to Al and Sham and Michael, of course. Your insights were very welcome, and especially, I guess, in fixed income, which is not as perhaps well covered as equities, especially Aussie equities, and a little bit more conceptually difficult, I suppose, to understand. Hopefully we'll see some of you again in a couple of days. Thank you very much.